Just don't want us to write the notes. Nataka tuelewe something about financial management and what we'll be doing. You are at this point. Let's say you are at year 0. This is what we'll be doing. We are at year 0 here. You company as a finance manager. What the organization wants to see, they tell you that in the next 3 years, we want to build a 3-story building. This is what the organization tells you. This is in their strategy. So we've said that finance is a branch of economics concerned with resource allocation, acquisition, resource allocation, acquisition, and investment, resource allocation, acquisition, and investment. Now, there are a few things there that I want you to understand that we'll be doing. So, we say that when we look at financial accounting, the portion that was touching on the finance part, the finance is basically looking futuristic. Let me look at that, futuristic, okay? But accounting is majorly looking at the past. It is historic. That's why you talk about historic cost, historic need. I am relating this to accounting because accounting is what you currently know. So it is good for us to work from it to get at the other direction. So when we talk about futuristic, we need to look at this is what we have, but this is what we'll use it in future. The main document we normally use to make this decision is the accounting documents. So now you have the accounting documents, you've already prepared it. And then you as a finance manager, you've been given some money and you've been told, or maybe the company says that in the next 5 years, this is what we'll be doing, this is what we'll be doing. You need to understand, how will I allocate the resources I have? And majorly financial resources. How am I going to get them? That is, will I take a loan? Will I get it from my profits? Or where will I get it from? And if I get it, where will I invest it? To a pattern. That is what finance management is all about. So you can say, the scope of management can be described using the functions of finance manager. The scope of financial management can be described using the function of finance manager. Using the functions of finance manager. These functions can be divided into two. These functions can be categorized. Let's use the word categorize. These functions can be categorized in two. We have the first function called managerial function. And we have routine function. Some people call it operational function, but let me call it routine function. Let me say something here before we move ahead, because I just don't want us to write the notes. Nataka tuelewe something about financial management and what we'll be doing. You are at this point. Let's say you are at year 0. This is what we'll be doing. We are at year 0 here. You've been employed in a company as a finance manager. What the organization wants to see, they tell you that in the next 3 years, we want to build a 3-story building. This is what the organization tells you. This is in their strategic plan, that this is what they want to do. You as a finance manager, you are supposed to think, where will I get the money? Okay? Where will I get the money? What will I build? And then what else? We've said there are 3 things. Is where will I get the money? That is the acquisition of that money. Where am I going to, and how am I going to invest it? Okay? Those 3 questions have to be answered. And he's doing this when he's standing at year 0. All this is happening where? Because it is strategic. He is only thinking, what will I do? So financial management answers the question that the management asks itself, what will I do as a finance manager to ensure that my strategy is right? In fact, he's going to say, should we build a 3-story building or a 2-story building? Which one is more favorable for us? So that is what financial management is all about. We'll be using I don't want to say assumption, but estimations to come up with these decisions that he's going to make. So the functions of a finance manager summarizes what financial management is all about, because the person who is going to be in the driver's seat of financial management is financial manager. Tumepatana vizuri? So we can start with the managerial function. The first function is a managerial function. Managerial function. Managerial function. Managerial function. You can say these functions affect, these functions affect, these functions affect the value of the firm. These functions affect the value of the firm. These functions affect the value of the firm. They include, this one is like top level management. This is like top level management, and this is like the normal, the operational level. So the finance manager will have 2 types of functions: the top level management and the local one. So we can start. Which are these top level management? They include number 1, or rather Roman 1. They include investment function. The first one is investment function. So the first one here is called investment function. And you can see I'm getting this from the definition we had. I'm getting this from the definition we had. This is the allocation, investment function. This is allocation of companies' resources. Allocation of companies' resources amongst competing projects. Allocation of companies' resources amongst competing projects. Allocation of companies' resources amongst competing projects. Amongst competing projects. So you'll be looking at which projects are competing, what resources do we have. Let me say this. Maybe as an organization, you have 10,000. Let's say it's 1 million. 1 million Kenyan shillings. You have an option, you have 2 options. The organization wants to do 2 things. One, the organization wants to maybe to purchase a motor vehicle. At the same time, the organization wants to purchase land. And the cost of land is 1 million. At the same time, the cost of motor vehicle is how much? But in the account, you only have 1 million, you don't have 2 million. So you need to make a decision, do I invest in land or do I invest in what? In motor vehicle. So that's one of the functions of a finance manager, making that decision. Number B, is it Roman 2? I'm using Romans, Roman 2. Financing function. Financing function. Roman 2 is financing function. Financing function. It involves determining the sources of finances. It involves determining the sources of finances. Involves determining the sources of finances. We say it involves determining the sources of finances available to the company. Available to the company. And enabling it to be used and enabling it to be used, in the optimal manner. Optimal manner. So in short, the finance manager is going to ask himself, do I take a loan or do I borrow from friends? That's what a finance manager is going. That's another function. He's going to make a decision. Where do I get the money? Lastly, we have dividend policy function. Dividend from the word what? What is dividend? From section 1? Let me see if your ears was there. No, section 1. Mambo ilikuwa kula. What is dividends?
These are payments gotten from ownership of shares in the company.
So I can rephrase that. These are amounts maybe given to shareholders as a reward for investing in this business. So it is a portion of the profits that we give to shareholders as a reward for investing in our company. So you can say this is also known as profit allocation function. It is also known as profit allocation function. It is also known as profit allocation function. Dividends are profits earned. Dividends are profit earned and distributed to shareholders. These are profits earned and distributed to shareholders. Profits earned and distributed to shareholders as a reward for their investment. As a reward for their investment. So if you want to reward someone, you use what? Dividends. So this finance manager has to make a decision. We have a profit of 1 million or maybe 2 million. We have a profit of 2 million. How much do we retain as capital? We retain it that we don't distribute it. And how much do we give the shareholders as a reward? Do we give them the whole 2 million? Do we hold 1.5 million and give them the 500,000 to eat? That is what we have. So now we can go to Roman 2. We can have the routine function. Roman 2, we have the routine function. Roman 2, we have the routine function. These are supportive to the managerial function. These are supportive to the managerial function. And mostly delegated to junior staff. And mostly delegated to junior staff. They are mostly delegated to junior staff. They are mostly delegated to junior staff. They include there are very many others, but we look at exam setup, how they after as we move along in the topic, you see if there are some topics there, how has it come, how do you handle it. But number 1, implementing internal controls. Implementing internal controls in the finance department. Implementing internal controls in the financial department. Let me not assume that you I know this is an audit word. It is students always meet is first in audit, and I know audit is section 4. So hapa nikisema internal control, let me first see. There's something called what is the public perception but versus what is in reality. I know the word internal, ikiwa peke yake, you know it. The word control, also when it is also alone, you know it. But what do you think is internal control? Maybe you've never seen those words. No, you've seen these words. For those who go to church, you've been told these words. You've never been told these words in church.
Control.
You should have internal control. That if you see something, you don't just accept. You are not threatened. You are not being threatened about your controls. Yes. No answer is wrong. Every answer is true. It doesn't matter. You just have a different. Even the definitions we have, these were written by human beings. If you are told to write your own definition, it will be something close to what we have, but with a different twist. I'm going to say that definitions are based on personal experiences. It is not the truth, but at least it should have some words to describe. What is internal control? Even the Bible talks about internal control. Hey, what? Yes.
Rules and regulations that govern the way a department or an organization
functions, So these are rules and regulations that govern how a department operates. From your words, because I don't want to give you the definition, it is not in order to do something which is not in our context. But from your word, let me pick the key things. I want to replace the word rules and regulation with the word policy. So you know what a policy is? It is simply rules and regulations that the management has adopted as their own way of doing things. For example, you might be in SD and you might be in SK. You are borrowing from the same book, which is the Bible. But your way of living is different from his way of living. Meaning that you have things that govern you that some of them don't govern you. Ingawaje, you are borrowing from the same thing. So an organization will decide this is what is going to govern me. I'm going to be governed by A, B, C, D. Those things are internal regulations. And I think when you are, I'm looking for that verse somewhere, where it says that you should not be swayed by the ways of the world, but be transformed by the renewals of your. Can you remember that thing? Romans chapter 12, verse 1 to 2. It says something like that. That is talking about internal control. Internal control means that when you are here, whatever is outside should not be the one that's dictating you. It should be from you. And that's why the moment you say, unasikia mtu anasema ati ni huyu alifanya ati ni huyu alituma nikafanya hiyo kitu, then that person does not have internal control. You can remember when you were young, tulikuwa tunapigwa sana, tunaambiwa that you cannot ati niwe niende tuende tukaoge kwa mto. Afadhali useme ni mimi nilitoka peke yangu nikaamua kwenda nini? Kuoga. But it means you have your own internal decisions that you are making. So internal controls is very important. It is the management. It is the function of the finance manager to ensure that how the finance management how that department operates, it is him to come with how are we going to operate. So, because the buck stops with him. Number B, receipts and payment of cash. Receipts and payment of cash. Receipts and payment of cash. And C, receipts and payment of cash. And C, safeguarding financial documents. There are no others. Safeguarding financial documents. The others that I think in the next class we'll look at past papers. It's only that I didn't carry mine today, but we'll look at how has it come in previous years. You know, see if you Yeah. We look at next time, we need to look at how it comes so that if I'm done with this topic, I'm done with it. Okay? So let's look at another small subtopic, goals of the farm. Goals of the farm. What's a business? Let me hear. If you're told to define a business, what's a business? Any business. Define what's a business. I'm looking for just one keyword so that I can now understand or we can all understand. What's a business? Just one keyword. Nataka tu define when unataka. Unajua niwaambia no answer is wrong. I just want one word so that I can pick from it. Why is a business formed?
For profit making.
Profit making. So the moment the owner of the business enters into business, his main goal is to make profits. But as in the process of making profits, he'll find himself also aiming to do other things which is away from profit. So the main aim of the farm, I want to separate it and say financial goals. And then I can have other non-financial goals. Imagine a farm is situated somewhere in where? Deep in the village. It may say, surely we are here and we don't have roads. I can decide as I build my road, I can also build feeder roads for the community. So at that point, he will be doing that. It is not a financial thing. It does not help him in anything financial. Because when we talk about financial, we'll be touching so much about profits. Okay? But when you talk about non-financial, it means it is not the main aim why the business was formed. So let's start with financial goals. Financial goals. So there are two types of financial goals. We have profit maximization. And we have wealth maximization. First we write, tuandike kwanza, then I'm going to explain the difference between the two. So the first one is profit maximization. Profit maximization, that is A. Profit maximization. Profit can be defined as the difference between income. Profit can be defined as the difference between income and expenses. See, that's how we define it. Now, that is the main aim of the farm. It can be defined as the difference between income, or rather sales, sometimes call it sales, sometimes income, sometimes revenue. And I told you the difference of the three depends on what type of the organization you are in. Is it doing sales? Is it doing a product? Is it doing a combination of both? Is it an NGO? Is it doing services? A farm may increase profitability. A farm may increase profitability by either, there are only two ways to increase profitability from an accounting point of view. Either by increasing the selling price or by reducing expenses. See, according to those two options. So it might increase profitability by either A, increasing selling price, increasing selling price, holding expenses constant. Holding A, increasing selling price, holding expenses constant, or B, reducing expenses, or B, you are lost, you okay, or B, reduce expenses, holding the selling price constant. Those are the only two options he has. To increase the selling price if you hold the expenses constant, or maybe I increase my selling price because I'm assuming it's the same goods. So if you have, let's say, let me explain. If you had sold, these are the units, and if you had made sales, if you have sold 1,000 units, each at at 50 shillings. It means your revenue, or rather your income, your sales, let me use the term sales. Your sales will be 50,000. That is what your sales is. You have an option, and then your expenses, the cost of this selling, it was maybe your expenses was 30,000. It means your profit was how much? 20,000. So I have an option. If I want to increase my profit here, this 20,000, the first option I have is to increase this selling price from 50 to maybe 70. It means that my new sales will be how much? 70,000. But my expenses are remaining the same at 30. It means I have increased my profit to 40,000. Okay? That is one way of looking at it. So the other way is by reducing my expenses, holding this constant. If I reduce this one maybe to 10,000, maybe to 20,000, it means that my new sales in such a situation will be 50,000, and then this one minus 20,000, and that is that. So there are two ways of increasing this 20, either by reducing my expenses or by increasing my selling price. So, a new sentence. These two strategies may not be sustainable. These two strategies may not be sustainable for the long run. These two strategies may not be sustainable for the long run, since increasing the selling price means overcharging customers, while increasing the expenses, what does it mean when you increase the expenses? We can use employees as our anchor point to explain. Means underpaying workers. It might mean underpaying workers. You can also look at if let's say it is a product, it means you are reducing the quality of the product. Why are you saying this is not sustainable for long? If you underpay your workers, what will happen? Your products will lose value, right? When your products lose value, the customers may start saying that now we don't want this product so much. It is not a good product, because maybe the quality will also reduce. If let's say you are baking bread by yourself in the house, and then initially the cost of that bread was 30 shillings, and you are selling it at 50 shillings. So this time you decide, maybe I was using two eggs. I want to reduce it to 1 egg. So we reduce expenses. But what happens to the quality? You have also reduced the quality. After 2 or 3 times, people will stop eating your bread. Okay? So that is what we mean that it is not sustainable in the long run. So let's look at the other one. The other one is which one? What are the disadvantages? Let's look at the disadvantages of profit maximization. Sometimes it can be case against. Why is it not making sense? Disadvantages of profit maximization, or sometimes you can call it the case against. Let me hear. Why do you think it is not making sense? Can I have number 1? Short-term goals are not consistent. Short-term goals are not consistent with the going concern of the firm. Short-term goals are not consistent with the going concern of the firm. Can you remember what going concern is? Let me hear. What's going concern?
The business will continue to operate in the foreseeable future.
The business will be operational in the foreseeable future. So imagine the business is not, the future is not known. Because profit is always described after every 1 year, 1 year, 1 year. So if you have a short-term memory, but maybe a short-term plan, unafikiria to 1 year, you never think of the business in terms of 20 years. So if you only think of profit maximization, that limitation of going concern always comes into place. Number 2, it is ambiguous which profit should be used. It is ambiguous which profit should be used. Or rather, which profit should be maximized. It is ambiguous which profit should be maximized. Is it profit before tax, PBT, profit after tax? Those are different types of profit. Operating profit, we have profit after tax, interest, or whatever. Is it gross profit? Which profit are we talking about that should be maximized? It is very ambiguous which profit we are talking about. Number 3, it ignores the concept of time value of money. It ignores the concept of time value of money. It ignores the concept of time value of money, i.e., it does not distinguish the different timings of receiving the money. It does not distinguish the different timings of receiving the money. Let me explain, because explaining is very important. Time value of money is this. Let me even use 1 year as an example. Just 1 year. Look at 1 year ago. 1 year ago. In January, 1,000 ilikuwa na, is it the same as 1,000 ilikuwa na December? So unapata ni lose value. Let's give it 5 years so that it can make sense. 5 years. The 1,000 ulikuwa na 5 years ago. Is it the same as the 1,000 we have now? No, it is very different. The difference is money is subject to things like inflation. It is losing value. So when you talk about profit maximization, we assume it is the 1,000 you got in January is still the same value as the 1,000 you have in December. It does not take into consideration that this money has actually lost value. It is taking it as is. So this will be the main, we have a whole topic about it. Furthermore, this is like the same way when we were doing financial accounting, accrual was our main thing, okay? Time value of money will be our main thing here. You must always consider time value of money when you are describing all these aspects. So, ensure that you know it. Let me try to explain that this time value of money for the purposes of, because it is our main thing. I'm very sure even if I take 2 more minutes, it is not going to cause any harm. So here we have the year, and here we have amount. So let's say in year 1, you got 9,000. Year 2, the income, this is the profit. You got 9,000, and year 3 also 9,000. Now, this is scenario 1. This is scenario 1, and this is scenario 2. Then, if you look at this scenario 2 now, the profit here was 0, and here is 0, and here is 27,000. You can see the total is 27,000. So it's total 27,000. So now I'll ask you as an accountant, which, if I was to give you money within 3 years, which one do you prefer? Look at both. So you have a problem here. Either ungoje 3rd year nikupatie 27,000 ama kila mwaka nikupatie 999. They are all totaling to 27,000, but you have started having some problems. And the problems will start cropping up because of why do you need money? Some people, when they hold money, they feel good. So you want to start feeling good from year 1. Some people will say, if I get this money, I want to invest it somewhere else. So if you give me an investment somewhere else, it's going to earn me more money. So you still want to hold that money. Some people will say, that if you give me this money now, it will make more sense. It is going to, even if I hold it, it is going to earn me a single shilling. Kwa Biblia inasema afadhali ungepeleka pesa yangu hata kwa banki inipatie shilingi ngapi? Moja, kuliko kuiweka chini ya mattress. So, and this other guy will also say, I know myself. Ukinipea hii pesa nitakula. So afadhali unipatie usiku wa mwisho. Ndio nikuwe na 27,000. So there are different reasons why people hold money. Now the first reasons that I gave, other than this last one, this other the reason is the reason why you need to evaluate what is the reason for holding that money. Why do you need that money now? So the time value of money, or rather what we call, okay, let me just use that concept of time value of money. We're going to look at it again and again. That time value of money will tell us which option do we take. Which option do we take? In they are the same, they are not the same. So we can look at another subtopic: case against profit maximization. Case against profit maximization. No, case for. This was against, we just handled against. Case for profit maximization. Number one, the main aim of the business is to make profit. The main aim of the business is to make profit. Do I need more notes on that? So as you know, it is aligned to the main aim. The main aim of the business is to make profit. So technically, this one is aligned to the main aim of the business. Number two, profits reduces risk of business concern. Profit reduces risk of business going concern. Of business, let me use the term business going concern. Number three, profit is the main source of income. We'll see that it is the cheapest and the easiest available. Profits are the main source of income. I want to use it as is, but I want you to understand that it is the cheapest and the easiest available. Pesa umetoka kwa mfuko yako ni rahisi kuliko pesa umechukua kwa third party.